In the regionals, people forget regionals can fall up to 100%.
The easiest way to make those assets valuable and attractive.
These buyers agents that guarantee returns and the risk associated with that.
You're tuning in to The Property Couch, Australia's #1 property, finance and money podcast. Featuring the titans of the industry since 2015, we're trusted by tens of thousands of investors on their journey to financial peace. This show is powered by More.
Thanks, Opti. Yes, and welcome back to the #1 property podcast in Australia, The Property Couch. Welcome back, Couchers. We're thrilled to have you along, and we do have a big show today. I've got one of my regulars on the couch here, Shane.
Couches.
Welcome back. And we've got a brand new special guest, Lachlan Delahunty. Welcome, mate. First time in.
It is. Thanks for having me.
Now, before we learn more about Lachlan and his backstory and what the value he brings as one of Australia's leading property experts, I want to talk to you about a couple of housekeeping matters. The More negative gearing calculator and modelling analysis tool is going off, so you can now do modelling. Remember, negative gearing is not gone. It's just a deferred benefit. So we've built this calculator inside More that allows you to model that analysis in terms of if you did have negative gearing, what the cash flows look like, and if you didn't have negative gearing, what the cash flow impact will be. And then you can also do side-by-side analysis. So make sure you check out that tool. Because a lot of people are still thinking negative gearing is gone for existing property. It is not. Also, I want to share with you, due to popular demand, we have extended the replay on Fact versus Fiction, which is a webinar I did a few weeks back. And because also people are demanding the slide deck, you can now download the slide deck as well, because it is an extensive look at what drives property, not only through the cycles, but over the long term in terms of scarcity and land appreciation. So you can now download that slide deck. Where can you get it? At thepropertycouch.com.au/webinar, and that is available to you. So check those two things out if you want to continue your education when it comes to property investing. Now, Lachlan, let's give you a better introduction than the first little g'day at the start. So let's learn a little bit about Lachlan Delahunty. He is the founder of Folio, which is a national property advisory firm helping Australians build high-performing property portfolios. Folio is head-based in Western Australia in Perth with a national footprint across the nation. With over a decade of experience across valuations, advisory and acquisition, he brings a wealth of knowledge from a data-driven, strategy-first approach to property investing, which is what every professional organisation should do, as opposed to these hyperbole buyers agents who say they do that but don't really do that. Lachlan is a qualified valuer and licensed estate agent, and you have been involved in more than $2 billion worth of acquisitions. We're going to ask about that, property transactions. He's also the co-host of the Folio Property Podcast, where he shares practical insights of building wealth through property investment. And I did appear on that podcast recently, back on the 24th of March, where we did talk about the potential changes to capital gains tax. We didn't think they would do anything about negative gearing, but they did. So we're going to come back for that. But mate, that's an impressive resume you've got there. We're thrilled to have you on for the first time and getting knee deep into your story. But before we do that around property, we always like to start with your money story. So you grew up on a farm in country Victoria. Tell us what that was like, and did you talk about money over the dinner table during that time?
Yeah, so the little town I'm from is Matoa in country Victoria, halfway between Melbourne and Adelaide. And although the family was on the farm, we moved into the town for most of my upbringing, and money was certainly a conversation, right? It's one thing you know about farming cycles. They're more exaggerated than residential cycles in the sense that drought years pretty much bury a lot of farmers and a lot of families, right? So you really see an insight into the good times when there's plenty of rainfall, and you can go through decades of drought years which will cripple businesses, families, and so saving and the importance of making sure that you never get too ahead of yourself when you do have good years, because you never know when the next bad one is about. And I think as we're going into the property cycle now, it sort of reinforces that, right? It's all about all seasons, and we've probably come off a longer summer period when it comes to property investment for the last 5 years. And in the farming world, it's no different. But a drought or a winter's never too far away. So money for us in the family was always any dollar we got, make sure you save it because you'll need it for that sort of next drought. And
so how many sort of couple of other siblings?
Yeah, got an older brother and sister.
Yep.
Big goal for my family was to get them to university, something Mum and Dad never got the opportunity to do.
Yep.
And rather than stay home, like a lot of people do in the area, which is fantastic, to stay on farms or stay in the township, they were big on getting academic education first. And their whole goal in their life was to save enough money to put us into university, which they achieved that for all three of their kids.
Yeah, okay. And so, in terms of, given that obviously farming is a lot of it out of your control, as you're talking about in terms of rainfall, that's the critical thing, but you're also managing debt levels in terms of putting crops in and those types of things as well. But how did your parents talk to you about, the benefit of saving, and did you go off and do other jobs, or were you near a town where you could actually earn a pocket money or anything like that?
Yeah, well, that was it. We were in the township itself, and Dad sort of made sure that we all went to work at a really young age. And I guess put the understanding, you don't really understand the true value of money unless you earn it, right? So whether that was paper runs or, I was umpiring at the local footy or water boy or any sort of,
So you're a glutton for punishment?
A little bit, yeah. Definitely. It was, and from a young age, we're working 6 days a week, like doing a postal mail run during the week at 5 o'clock in the morning, run my push bike around when it's raining, and then on Saturday you do the scoreboard and a water boy for the senior game. So it just didn't stop, and then you really got an appreciation for what money is, because it's hard to come by.
Yeah.
And then more importantly, when you do get it, it's not going out and buying all the fancy things that you don't need. It's putting that to use, and that was sort of reinforced really young, that you never sort of abuse, you always appreciate the value of money and the scarcity of it and what it can do if you do save and put it to work. And that was the thing, we're putting in a bank account at a young age and then getting interest on that, and at the end of the year would sit down and see how much interest was accrued, and that sort of compounding sort of story starts to embed.
I can't think of a better upbringing in terms of understanding the value and effort and exertion that you need to understand the value of money, because now you have an appreciation for it and a healthy respect for it in terms of what it allows you to do. I think that is a perfect backstory. The next generation of kids that are coming through, Australia is quite a fortunate country, and we don't necessarily have those types of pressures in a lot of households. But I think it is an awesome grounding for people if they can get themselves a part-time job and then understand basically where all that money's coming from, mate. So that's a good story. Now, before we go on to the topics that I want to get into today, $2 billion worth of property acquisitions. So take us through your property journey. So how did you get into this space? And then obviously that led you into obviously setting up Folio over in WA. So take us through your professional journey into being the property investment advisor that you are today.
Yeah, so I did the course here at Deakin University, real estate and valuations, and specialised in valuations. When I graduated from that, I got a job with JLL in resi valuations. That progressed into more development and commercial valuations. And what I soon realised is, being a valuer, you don't get a lot of appreciation for what you do. It's typically bad news, and if it's good news, you don't hear anything from it.
No one ever says thank you.
No,
for
they
valuation,
don't.
do
Like, surely it's worth more than that.
Exactly, that's the
Surely
conversation.
can you go back and have another look?
And how much to bump that valuation up? I sure you were
Yeah,
asked
it
quite
was
a
all
few
those
times. Yeah, of
conversations.
course.
But what I was finding is that after the fact, after the purchase, my advice becomes a little irrelevant. When if I had have got some pre-purchase advice, I'd tell them, don't buy that asset, or that development site's just not going to stack up on a feasibility. Don't buy it. After the fact, it's too late. I said, you shouldn't have bought that asset. So then I sort of led the advisory team at JLL. They didn't have a department in really buyer's agency.
Yep.
So went in there and set that up. Problem was, big company like that, a lot of red tape, had a national footprint that wouldn't communicate together. So left there, went to a smaller advisory firm where it was sort of boots on the ground and national presence, which was really important because at the time I was in Perth, 2014. It was very clear that it was peak cycle and things were just overvalued, and it was, there was more people leaving the city than they were coming, and prices were, going up and up and up. And for me, I didn't feel comfortable investing in that market at that particular time, yet the firm at JLL that I was in was instructing me to do so. And it just went against my grain. If I'm not putting the money where I'm investing into the same market that I was required to advise my clients, it just didn't sit well. Yep. So I left that firm.
So you weren't aligned.
It wasn't aligned at all.
Yeah.
And that's sort of my ethos is, if the first purchase in any market that we invest in has got to be from myself and fellow employees and directors. So then that led to a smaller firm that sort of was more aligned in being able to invest in markets driven by data and purely by data, which was outside often your backyard. And then fortunately Perth become a market that was attractive again in 2018, 2019, which enabled us to sort of capitalise on the market that we're probably most familiar with. But up until that point, we're investing in Adelaide, Brisbane, pretty much every market around Australia besides Western Australia. And then for the last sort of 5-6 years, Perth's been a really good market for our clients.
Yeah, beautiful. So let's sort. I want to get through, highlighting what we want to talk about today from a perspective. We've got a few things we want to get through. Obviously, I want to talk about the tax grab, the federal government's tax increases in negative gearing capital gains tax. I want to talk about what we think investors will do and what they should do. I want to talk about the recent collapse of Dashdot as a buyer's agency, and these buyer's agents that guarantee returns and the risk associated with that, which I've talked about before, but we've now seen it playing out. Then I want to refer back to the importance of asset selection. And then I want to have a bit of a discussion around what we do around passive active strategies and whether we still think the passive strategy and the active strategy is still good. So it's just great to, Bryce and I used to talk about iron sharpening iron. And so there are a group of professional buyers agency businesses out there that we have a lot of respect for, that they're not, hyperbole merchants, that they do spend a lot of time in the data and do the right thing around that. But anyone can make data sing as well. And so we're also seeing certain buyers agents select a certain patch of data and then tell their story to get the volume of transactions that they want, as opposed to whether that's the best long-term view in that particular market. So let's start with, obviously, the first question, which was around post the capital gains tax and negative gearing reforms. What do you think what's been the feedback from people asking you questions about what they think they should do? Is there this flight towards, we've got to chase cash flow and we've got to chase, these new yields or new property?
There definitely is, and I think there's just never been more uncertainty in the market, right? And I always talk about certainty can drive markets and sentiment can drive markets. At the moment, there's complete uncertainty because people are trying to work out what this looks like. And the easy sales point, and I think that's what the government's done, they've essentially given free marketing to these house and land spruikers, is, cash flow has become arguably more important. But what I'm really scared of is the flood to these house and land packages. And that's already, you would have seen the number of Facebook ads just explode. The story around, how you can get cash flow and benefit from negative gearing. The ironic thing is that the properties that they're spruiking that say they're going to get negative gearing benefit typically don't get a lot of gearing benefit anyway, because they're either neutrally or often sometimes positively geared if they get a tenant. You go into these areas where there's mass supply of house and land packages, which are 80, 90, sometimes 95% plus investor driven. So they create these ghettos that vacancy rates explode into the 5, 6, 7, sometimes double digit sort of vacancy rates. And what people fail to understand is that's fine. It's a flood of investors go into the market. But if you are an investor in that market, you've always got to look at your exit. And you speak about in your podcast all the time, Ben, is you want to target the most broader audience you can when you're selling. That's typically owner occupiers who are going to get emotionally drawn into the asset. These ghettos of investors, albeit they get some benefit with capital gains and or negative gearing when they purchase it, but when they go to sell that buyer,
it's not secondary anymore.
It's not secondary.
There's no purchaser for that.
There is. So the buyer pool is now it's zero, because owner occupiers don't want to live there because they're become ghettos and they're driven predominantly by investors. Not typically probably where you want to raise a family, not always, but in some cases. And investors are not going to buy there because they don't get the benefit. So that's my biggest concern.
The easiest way to make those assets valuable and attractive to owner occupiers is to make them cheap. So you're at risk of not getting the capital growth out of it as well as you would get closer to agglomeration cities and capital cities in areas that have diversity and scarcity around their land supply.
Correct. And that's what I'm really concerned about.
Yeah, and I think, when you unpack the story here, we've analysed the Queensland market with over 1 million transactions from 2000 to 2015, and we looked at the time of build, right? So effectively, what you're trying to do is you're trying to study where the new subdivisions are occurring, because obviously that's where this stuff is going to be built.
Yep.
Because they need to do it in volume, and they're selling volume investors into these locations, right? So that's to your point around potential risk of oversupply in the ghetto. But you've got to understand, and this is we've been talking about this for years, but I think it's timely to remind people that you've got the land value and then you've got the improvements on top of that. And we've been talking about the best ratio is between 60 to 80% on a freestanding house. Usually, our entry level is around 60 is a good time to get in. Now, what we're seeing in these particular transactions is that the improvements are higher than the land value, right? Now, what happens in these areas is because there's an abundance of future supply, because you're on the fringes of the city, the first 10 years of returns are underperformed because there's no scarcity on the land. So the land's not appreciating. So you're not getting that initial capital growth in those first years. So what the analysis showed is you were typically getting around 3.5% to 4.5% in that first decade. And the existing properties, which you're trying to sort of say like for like in the established areas that might have been, developed 10, 20, 30, 40 years earlier, they are getting between 5.5% and 6.5%. So the variation there is around 1.5% to 2% per annum over that first decade.
And compounding too.
Well, of course.
Yeah.
And so the reality is, because what's compounding? It's not the improvements. They're a liability. I mean,
Paint and curtains don't go up in value over 10 years.
No, they produce the income. But the thing that appreciates is the land. And how does the land appreciate? And this is what I've spent. So that's why that fact versus fiction is a long webinar, because I spend effectively an hour and a half explaining to people what you need to be looking for in regards to scarcity, agglomeration, all of these types of, Ricardian rent theory, all of these things that just clearly bring together the understanding that there is that businesses and humans will pay a premium for the productive use of land, and land is judged on its productive use. And so if the commute time and all of those other amenity factors aren't there, then the reality is it just doesn't move as well, and it's not as desirable. And I'll pay a premium if I go into those areas, which is what you study and what you know about asset selection.
Correct. The quickest analogy that I draw to when I get a call, which I was getting plenty of them over the last few weeks about, I think we might have to go new build. It's like buying a brand new car.
Exactly.
It's the day you drive it out the garage is its highest and best use in terms of its value, and then it depreciates, typically 15 to 20% overnight. You go back and say, I made a mistake, I want to sell it back to you, no problem at all. Here's 20% less than what you paid. That's like buying a house and land package. And then as soon as people hear that, they go, well, I don't want to do that. I was like, of course you don't. So there's no benefit in getting cash flow if it's worth less than what you paid for it.
Exactly.
And in these new estates, just down the road, there's a brand new house that's going to get built 12 months after yours is finished.
It's
more desirable.
They
keep coming.
Well, I mean, it does create this artificial inflated to market.
Yep.
Because unfortunately the uneducated investor who is going to be seduced by
guarantees
tax
and
benefits.
things.
How often have you been talking about? How often have we talked about that running something at a loss is not a smart investment, right? And so at the end of the day, why are you doing that? Well, the only reason why you invest in residential property for the long term is the capital appreciation.
Compounding growth.
Yep, that's right. The rent keeps you in the market. And as you get that growth, then what happens is, and as you pay that debt down, the future passive income that you're going to get off that property is a product of its value and what people are willing to pay to be in that area.
Yep.
So, if I want to be a renter in a prime location because of the school zones, the amenity, the social and demographic pooling that happens, because I want to be around like-minded people, and it might be the case that I'm getting an inheritance from my grandparents or my parents, because we know that there's $5.4 trillion of that coming in.
That's getting passed through now.
So that's going to get passed through. So I might choose to, rent in Hawthorne as an example, because I've got the kids in the best school, private schools or public schools or whatever it might be. So we know that is going to play itself out in terms of there will still be demand. But what will happen here is there'll be a hollowing out of the centre. in terms of, because you won't be able to build the volume of house and land packages, or you're going to be living in the city where you're going to be living in a 2-bedroom or 1-bedroom apartment, which
cramming
is
them
off the
in.
plan, and
Yep.
cram them in. So even those have no scarcity associated with it.
Yeah, exactly, and that's the next thing. It's got your house land package on one extreme, and you've got your off the plan apartments, which is, even more so not to do with, the amount of, talk about scarcity. That's what drives values. That's the first place where you lose that scarcity, when you've got not just tens or 20s of houses getting built, you're getting hundreds and thousands of the same product. And, if there's a rush to that, the quality is going to be reduced. They're going to push them through quicker than they've ever had. And we've seen that, Brisbane in the mid 2010s,
Yes,
where
yeah.
they just poor quality, oversupply, and then the markets fell, 20-30% in that unit apartment space. So it's a
And who's
it's a
the
void.
secondary buyer for that in terms of desirability? Like, I can mount a case for fringe city living with land, because that's a great Australian dream, right? That's what we've been told our entire lives is house and land. And if your only access to that is fringe city, there's potentially an owner-occupier purchaser for that. But there's a very small market of purchasers whose dream is a one-bedder in the middle of a city in a high-rise with 500 units in it.
Oh,
So the resale on
of
that is
course.
just so incredibly difficult and risky.
Yeah. Well, we're again in the fact versus fiction, the numbers were quite 1 in 4 of the off the plan apartments in Sydney produced a loss over 5 years, and I think it was like
4.
in Melbourne it was almost like 6 out of 8 for that boom period of the builds during that time, and that was BIS Shrapnel who did that analysis. And that's nothing new for our community, but if you're new to the community, you should know that we are just anti medium and high density. There is just no scarcity in that. The only exception to the rule is if you've got absolutely uninterrupted exposure to a landmark or something that's totally unique.
Yes.
Right? Which will mean that it just can't be replicated, right? And
The
and you need-
definition of scarcity.
yeah, exactly. Which is, if you just Google the toaster building that's, looking at the Harbour Bridge in the Sydney Opera House,
Yes.
that's a perfect example of no one else can build me out from here. It's relatively low rise, 6 or 8 stories or whatever. And so that building will come at a premium, because international, traders and all that will love living there. It's right in the heart of town. It's got everything. So there are those exceptions to the rule. But if I go
They're far and few between, right?
if I
They're
go
very-
150 meters into the middle of the CBD and I build a tower, and then that tower does have views of the harbour and the city, well, that's going to be the premium side of them. Looking out of the other way, that's
To
going to be
nothing.
solvable. But then what happens if, in 30 years' time, another tower gets built and I lose my view? Right. So that's the risk you have with those types of things. So, Lachlan, what should, if that's, we're trying to teach people to avoid those types of things, what should they be doing? What's the contrarian, but once you actually unpack it, what's the logical view of what people should be looking for? So when you wear your data hat, what are the things you're looking for from an asset appreciation and asset selection point of view and location selection point of view? What are the things that you normally look to unpack?
It always comes back to fundamentals, and no matter the news story or the inflection point of what the government's done or where interest rates are, it always comes back to the fundamentals, and that's what you look over the long term. And
Yeah.
you've been around longer than I have been, but there's been so many different periods with different cycles, and you've been through a GFC, a dot-com crash, COVID. What stands true is the fundamental, and that's first location, then your land component, and then your asset, in that order.
Yeah.
And location does 70% of the heavy lifting, and now probably does 85 to 90.
Yeah.
Land component does the remainder, and then your asset type, where it's become more relevant than it was pre-budget, I think it's trying to generate more cash flow out of the quality assets.
Yep.
So that might mean bringing forward that renovation that you're going to push down the track because, you didn't want to put too much pressure on buying a home and then paying stamp duty and then doing a renovation. Well, now it might make sense to do that at the start of the asset because you're going to increase the cash flow for the longevity rather than doing it at the end of the asset's life cycle. So, but the fundamentals haven't changed in terms of targeting location, land, and then asset, but just with more of a focus on how can we generate more yield, because albeit you kick the can down the road for negative gearing in terms of that benefit, to cash flow these assets over the next 3, 5, 10, 15 years, it's become more relevant than it was potentially pre-budget.
And more important too.
Yeah, maybe there are some smart people in Treasury, because this is probably why they forecast that there's going to be 35,000 less dwellings, off the back of these settings. Now, if this story is about, if Labor's selling a story about supply, and this is helping to drive supply, and they're thinking that the incentive will go that way, our job is to warn people about that risk, because the smart money will still stay where the land appreciation is the strongest. We've just done some recent analysis, and we're trying to do more of it as we get more access to the right data. But the cost per square metre of land, so we've been able to, sort of track that in the capital cities, and it's obviously clear, right? I mean, the closer to the agglomeration centre, which is the economic engine, because a lot of people then don't realise, they go, well, that's residential land will eventually turn into mixed use land, which will then eventually be rezoned. And so the city will then swallow up some of those types of things. And where it doesn't swallow it up is in what we refer to as the scarcity concentration, which is the regulatory capture that happens around, stopping the zoning changes.
Yep.
So you get that land scarcity, Middle Park, Albert Park, those types of things, where they just will not let anyone, change the rules, because they want the streets to remain those
as they are.
And that's the scarcity, and that's the desirability. And people love that, because there's no big through traffic in those areas, because there's no big arterial roads going through. So the land is absolute prime. And that's where it gets that, it gets graded as being, highly valued by all of those competing for it. And it's not replicatable. So off the back,
they can't
of that,
do it again now.
Yeah, no,
It's all protected forever.
And driven by owner-occupier activity, who we know, that's what regulates these markets. It's own occupiers, because they make up, in these areas, 95% of the total buyer pool.
Yeah, and then that's what we talk about in terms of getting the commercial capital that starts to roll in there, right? So how does it roll in there? Well, all of a sudden they say, okay, well, on the street that we're allowed to build the restaurants and bars and coffee shops and all, we'll do it, right? Because I'm going to get the foot traffic, I'm going to get the premium, so the restaurants are nice. So it just gentrifies those areas. So you can see, in the prime areas, that gentrification happened decades ago, but then you got areas like Yarraville and Seddon and all of those, where these villages, that was probably 20 years ago that started. But then you got Northcote and all of that. Like, you just see it. And
it's all coming along.
It's all coming along, right? And now that's moving out to Preston. So, High Street's having a renaissance, and Sydney Road will have that renaissance as they keep building. And then, they'll keep making investments into that, because they know they can't, basically, rezone a R1 resi, and that'll stay where it is. But what they might do is you'll turn that into a duplex, or a side by side, or whatever that may look like, and you'll get a few of those popping up. But that just then means your land value is what's getting graded.
It's driving it.
Every time someone is investing in that, your land's getting regraded, and it's being regraded based on the amenity in terms of what's attracting me to that area, because all of a sudden I've got good schools, I've got, that idea that I'm around people that have similar like-minded views and beliefs as me. So it's very livable.
Yep.
I feel safe in that. I'll pay a premium for that, and I'll get an emotional attachment to that, which comes back to that broad, the three things we always talk about is owner-occupier appeal. We say economic activity, human interest, and human behaviour. That all rolls into that particular story.
Yep.
So I reckon we've covered off on that. I want to get your opinion on regional, because I'm a little bit more concerned about what I call self-reliant regional centres. I get a sense of the challenges that I see in those markets, because it's not the same principle. By what I mean by that is, when you're talking about land scarcity, there's no land scarcity out in a regional area, right?
There's not enough population growth, right?
No, that's right.
It's self-sustaining through.
Yep.
business
So how does the land appreciate in those areas? Well, what we know from the research is that it's the cost inflation to build, because the land to asset ratio is completely inversed. So, you normally got around 25 to 30% of the value in the land, and then you got the rest in the improvement. So to your point, you're accelerating that new car in terms of buying that higher price. So that has to accelerate down. And how does that show up in the land value? Because how buyers agents sell these self-reliant regional towns is they sell them based on the fact that you can't build it you can't
The
replace
replacement
it.
cost story.
Yeah, the replacement cost. So that's the model that they have to use. Well, that's not an economic moat. That's not an economic flywheel. And if I'm only moving even 5 or 6,000 people out to a town that's got 50, 60,000 people, and they say, well, look at the percentage of population. It really means nothing in the sense of
It doesn't
the
drive
land
that growth.
scarcity.
Correct. It doesn't
So-
drive that growth.
So you run a little bit more risk when you're going into those markets. Have you noticed that in your data as well?
Without a doubt. And if you look at the long-term population growth on these areas, it's really important because COVID was, an anomaly, right? You
Yep.
saw a flood to regionals.
Yep.
That work from home lifestyle that was talked about, could have been here for a decade, was here for a couple of years, and then we've seen that migration now come out in the data that is flooding back
They're
to the
coming
capital
back.
cities. And
Yep.
sitting here in Melbourne, a huge part of that's coming back to Victoria here in Melbourne itself. So they've used this artificial period of time where there was some population growth into the regionals,
Yep.
and then fed a story around you've got to go in, it's the highest growing markets in terms of population in the country, you need to invest, and you're buying well below replacement costs. Well, that's just not true over the long term.
No.
And now we're seeing negative interstate migration out of these regionals back to the capital cities. And the unfortunate thing is a lot of the activity has been predominantly investors. So they've got to the price point where the locals cannot afford to buy that asset. Vacancy rates are on the rise. So
Where do they relocate to if they can't afford to live out there? Like, what's the push for them?
well, if there's no migration coming to these cities and there's only investors now looking to sell, you're going to see significant price falls. And I'm concerned, there's talks of in some capital cities, be that city, it might be down 10%. In the regionals, people forget, regionals can fall up to 100%. I'm over in Perth. Mandurah, post sort of that GFC boom, the mining
And the
boom.
mining boom, yeah.
Yeah. Mandurah come off in some areas 110, 120%.
Unbelievable.
So these regionals fall dramatically. You look at capital cities.
And people might say that's impossible to go back behind zero. So just explain what you meant. So it had a run up and then it fell from that run.
Exactly.
Yeah,
Yeah,
I think it's
exactly. Yeah,
important to-
huge run up where
Yeah.
it did, almost that growth.
So there might have been 400 up to 800 and back to 360.
Exactly.
Correct.
Yeah,
Yes.
below what it was originally
Yeah.
trading at
Yeah.
before the boom. And that's important to articulate, right?
Yeah.
But with capital cities over the long term, you won't see that level of volatility. I think the worst capital cities performed is, negative 10% over the last sort of 20 or 30 years, where these regionals will fall often 40, 50, 60%.
And quickly.
Because there's no buyer. It doesn't exist.
This is the whole point I make around thinly traded markets. Property is heterogeneous, which obviously means that no two properties are the same. There's always some, even on a street, you might have one property that has a westerly aspect and one has, northeasterly aspect or whatever it might be. And one looks over a park and the other one looks over a group of houses, but it's on the same street. But even you can't judge those two bits of dirt the same way.
There's always something.
So it's always heterogeneous. I mean, actually, here's a little update, a little anecdote. I've over the journey of this podcast, I've talked about the property my very first property that I bought when I was 21 or 22, whatever it was, in Bundoora, in the court that I grew up in. Well, recently that property sold a couple of weeks ago at auction. Yeah, it went to auction, right? And Melbourne's a depressed market, right?
It is.
And there's certainly some challenges in the Melbourne market. Now, that house I look at it, hadn't been renovated much, just basically still 3-bedroom, 1 bathroom. It had an extension when I bought it out the back, which is like the pool room, the classic extension on the back. So AV Jennings, 3-bedroom brick tile home, right? Now, they were quoting 780 to 850 and it went for 991. Now, and now the court that it's in, it's a good sized court. You can kick a footy in it and play a good game of cricket, because that's what we used to do when we grew up there. We had about 13 kids in the 2 course.
We were talking
in
about
the
your
area.
Glenn McGrath run up before we went to air.
So here's the point. Now, that goes against what's happening in the market, right? That is a stunning result and all it needed was 2 emotionally charged buyers who wanted that court location.
They just saw it fit for purpose for them and they
Correct.
went after it.
Likely owner occupiers.
Exactly. Well, let's hope it's owner occupiers. I mean, if a buyer's agent's responsible for that result, as an investor, they need to be
Haven't done the
sacked.
job.
Yeah.
Right?
Contextually too, that pricing for Bundoora in this climate, the top end of that range is largely accurate. it should be somewhere a mid to maybe a high 8, and that's it.
Well, I mean,
It
this is
shouldn't
the
have
old
been
part.
more than that.
There's University Hill and there's other part. And Bundoora is a massive suburb.
It's
right?
huge.
Like it's got about 16,000
But
properties.
that
in it.
particular address was about right.
Yeah.
But
So
the
this
991
one's the old part of Bundoora, right near Watsonia, and now obviously, this is the mistake. I said it's costing me about $500,000. I bought it for 120,000. I sold it, I think, for 165,000, and now it's 991. So, okay,
Leave some money off the
There's
table.
a bit of a left of money on the table there. But
A few shekels.
But what are we trying to prove to you? We're trying to prove to you that it doesn't take much to form a market, and if that market is formed by investors and they're buying in these regional towns, selling a yield story, because that's potentially what they're doing. But they're being very selective about the data that they're saying this is what's going to happen. But then they create the market. Like it's the meme stock of residential property in Australia is this whole idea of so I'm with you, Lachlan, in terms of I'm saying that some regional markets I would be saying, they are not buy hold. You need to be thinking about trading in and out of those markets.
Yeah, you need to be thinking
because
about
you
your
could
exit at entry.
You could be exposed with a serious correction. And all these people who think that they've made paper profits, here's the other kicker. Come the 1st of July 2027, that's when you get to lock in the value. So if they lose 20 or 30%, or even let's call it 15 or 20% now, that artificial inflation that the day that we're recording now, they think their
paper
property's
profit.
worth that. They're actually they may not be able to lock that profit in. They have to then reset their capital base back here, and so they're going to be paying. They're going to be, if they do sell it, they're going to be paying taxes on a higher, off a lower gain base. It's like, ooh. So I think there's a sting in that particular tale as well.
Definitely, and I think it's important, which you highlight all the time, the difference between a regional that's close to proximity to a major CBD,
Something that's commutable.
Yeah, be that Geelong to Melbourne, versus a Gladstone, to highlight one individual that is essentially a mining town, and we see these, but it's a port-based story there. But you're right, and I hate to say it, a lot of these firms, it's essentially a pyramid scheme in the sense that the founders of these companies will go in there and buy up product first, artificially inflate the markets with their clients, and it's the last client that they've bought for that gets stuck with this asset that unfortunately there may not be another buyer for it. And yes, the idea is you want to trade out of these assets, and we're a buy and hold business. Buy quality asset, hold for the long term, but not if it's a C or D grade asset. And that's where we sort of highlight these regionals as C and D grade assets. But the problem is it's going to be very difficult to trade out, I think, post this budget, because you're seeing these regionals come off, you're seeing vacancy rates rise, and you may have to get out potentially at a loss in some situations, and that's really hard to see and see clients go through that, because it causes a lot of pain and stress on their financial situation.
Is it fair to say that if you see, regardless of some of the guarantees, which is a separate issue, which I'm sure
we're coming to it, yep.
But separate to those things that some of these spruikers put out about an area, if their offering is yield and tax benefits, that's actually not an investment strategy. Those are not things that you would bank your money on in the long term.
No,
right?
but to Lachlan's point, what they're doing is it's classic investor hyperbole, right? It's like, I got in here, this customer got in here, and their property's gone up by $60,000 in 6 months. What do all investors want? They want the best return they can possibly get as quick as possible.
Yep.
And so that's then they get sucked into the sale, into the marketing pitch. And then they create the volume of demand to manipulate those regional markets because they're so thinly traded and they're such small markets that it's easy to go in with 50 or 100 buyers. And if there's, half a dozen of these what I call, new age buyers, agency businesses that artificially agree that the same, they're looking at the same data and saying the same thing, like, oh, look at this, days on market's coming down, vacancy rates are really tight, yields really high. We're going to go into that market too. And then
And it's cheap. That's
and it's cheap.
Yeah.
And, they sell it on, well, but as we also know, it's access to credit. So they did the trust lending, which got them the opportunity to get the money because it was basically a low doc or a no doc loan. So they were able to go in and buy multiple, and they're thinking they've done really well. But
and
now
using
Imagine being that
desktop
buyer and
valuations to prove their point,
values.
the values that
Correct.
they've gone up to be able to
not
recycle
sales.
Yeah.
fake equity, because it doesn't exist. It's not real value when the
Yep.
banks themselves have these desktop mechanisms that artificially inflate the value of the property. So it's not real equity that they're using to then trade in, buy more. So they're the ones that I'm most fearful, because they don't have the incomes to support a winter. And a lot of these markets are coming in, winter's here.
Yeah.
And
It's only going to get colder too.
it's only going to get worse before it gets better. And they're going to be overexposed at debt levels they can't afford to manage, and now go into a situation where some of their assets, and potentially majority of their assets, could be in a negative equity situation. And that's when you become a prison to your debt.
Imagine being the last person to buy in Mandurah at 800 before it went back to that 360 story.
switch the lights off for what, 14 years? How long did it take before it got back to parity?
Yeah, another 15.
Yeah. So switch the lights off.
Wait
and then
15
so
years.
And
then
that's to
there's
get back to
opportunity
even.
cost associated with it.
Yeah.
Yes.
15 years.
We had
of
one in
no-
Karratha, a gentleman on who bought one in Karratha for $1 million. This was back in 2008, right in the boom, and mining town. And he sold it for 1.2, and he writing was on the wall. He goes, I needed to get out. That person he sold it to traded for 3 years later for $350,000.
Oh, Jesus.
Right? I mean, we're
Like,
fortunate.
these
that
things do happen.
they do
Yeah.
happen, and we get to see them. That's the problem.
Yeah.
Right? I mean, but
And pick up the
unfortunately,
pieces when these Cowboys leave.
yeah, because look, there's low barrier of entry to become a real estate agent, right?
Mhm.
And there's effectively no regulation about what they can and can't say on marketing.
Yeah.
Financial planning businesses, we can't do anything like that. We can't sit there and say we got our clients into NVIDIA and we made them a 4,000% return. You can't do it.
In 2 days.
Yeah, you can't do it, right? So these guys get away with it. And to your point, they spend tens of thousands of dollars on social media, which is our perfect segue into a business. And as I've said, I've never, I think in abundance, and I want, we get other businesses on this podcast, right, who compete with our own business. And that's fine, because we want the best businesses to look after clients out there in the marketplace. But and I'll never, name a business unless it's been publicly declared as something has happened to that business. And I'm speaking in statements of fact. And what I'm talking here about is Dashdot, which is a buyer's agency business that had a meteoric rise in terms of their awareness. And, I think reportedly over 1,800 properties or whatever they bought over a very quick period of time. Well, a few weeks ago, they announced that they were going into a voluntary administration. So again, all statements of fact. The number of properties they purchased, please double check that in terms of that. But here's the issue that I have in terms of, obviously it's now coming out that they charged an upfront fee in a lot of cases. So those people are potentially lost their upfront and not got any result out of that. Now, I don't know what's happening with those, whether they're going to try and refund their money or whatever. But they, inside their contracts, not all contracts, I can't guarantee that on all contracts, but we have a version of their contract because someone has come back to us and said, I've been burnt and we want to work with our business. That's fine. And here's the contract. And inside that contract, it read that they had a guarantee that if the property didn't perform 10% above what they purchased the property for in that market, then they would refund them their money.
The full amount.
The full amount. And the reality is they're no longer in business. And so you got to ask yourself the question. Now, again, I don't know the truth here, but why did they shut up shop? I mean, ultimately, if you've done that type of work and you're charging that type of thing, I know the margins in buyer's agency for good businesses and poor businesses. And I know that there's, these people were spending a lot of money in terms of social media marketing, but they've obviously also, they haven't run at a loss and they haven't necessarily done poorly in terms of their own potential, the owners of the business, that is. So what's going to happen to all of these people who, to your point, if they're bought in regional towns and there is a revaluation in those markets?
Well, there's one definitely coming in July next year.
Yeah. So the reality is what's going to happen. They won't be able to go back and get their money back. So it's a warning for anyone, isn't it, Lachlan, around guarantees. How can I make a guarantee in any type of investing?
there is no guarantees, and anyone that's going to promise you that, it's a red flag straight off the bat.
Straight away.
And
It's
that's
a big red flag.
massive. And there's a few things to take out of this. Firstly, there's been a spike in buyers agencies post-COVID, right?
Yep.
And looking back to anyone that's listening or going out into this space, it's do your DD and make sure that the business and or the founders of that business have been around for a couple of cycles at least, particularly before COVID, because post-COVID it's just been a boom of speculative buyers agents, and
Everyone
Dashdot
looks like a
are
rock
in this
star.
category, right? Second to that, these guarantees are getting thrown around so loosely, and here's a perfect example where they won't be ever held to account for that guarantee. So there's firstly the pain this will cause from people that have potentially lost huge deposits in terms of upfront fees and or want a refund for those guarantees. But where I see the huge problem out of this, you're going to have potentially thousands of clients that have bought assets all over Australia in what we say potentially some questionable markets. Now don't have your advisor, your specialist in that field of property to lean on when things get tough. And it's like, you go to an accountant, say you've got a small business, my mum and dad, for instance, they rely on their accountant so much for their decision making around their business. If they were to shut up shop and go into involuntary administration, the damage that would do to my family in the short term and then the medium term to try to unwind all that advice that they've got to go get and find another accountant, and it becomes...
And imagine trying to trust someone again.
That's what I mean. So
Like it's cost you $27,000 of your hard-earned money that you've saved after tax, however many weeks or months or years that took you to get into that fortunate position. Then you go and buy the asset, they leave, the advice is wrong or misleading or not stood up to what it was meant to be, and now they've got an asset that is worth less than what they paid for it.
And they've got no one to go to, and this is my point. It's
Mind-boggling.
Like you sign up for a property advisor, not just for a purchase. Well, it shouldn't be a buyer's agent
there's
or
more to
investor.
it.
There's a lot more to it. How to manage your portfolio.
Yeah.
That's what we talk about a lot. It's not just about what you buy. It's how you manage that over the long term. Now they don't have that person to go to, and if it was the wrong advice in the first place, these people are going to be left in the dark, and it's concerning because these typically, broadly speaking, are some of the most vulnerable, right? The more sophisticated investor probably sees through their marketing campaigns and their sales techniques. It's more, I look at mum and dad, they'd be more vulnerable to this type of program where someone says, here's a guarantee, we've marketed really well. We've got really aggressive sales techniques to say that you must buy in a regional because your retirement, you're not going to have enough to retire because you haven't set yourself, make them feel really, really guilty. And on the basis of that, you need to buy 2 or 3 regional assets. And typically some of these firms, that's what they do. The unfortunate thing is they're the most vulnerable in terms of their serviceability may not hold up. And now we're in a rising interest rate environment. And we've got potentially deflating house prices. And they've got nowhere to go because the person that they thought was the expert in the field is no longer in business.
Yeah.
There's a lot to unpack here, and I'm sure we'll be picking up on this particular topic in future episodes. But the interesting thing here is that these buyers agency businesses, they will shut up shop. They're no different than the spruikers of the first generation spruiker, which were the house and land package guys and all of that.
Yep.
I've seen countless businesses that have had their run, opened up to sell house and land pack, and then some of them even charge lifetime membership for like $8,000-9,000. And then as soon as it got tough, they just shut everything up. Now, the sad bit around going into voluntary administration is, what about the entitlement to the staff? They're also Now, again, I don't know what's happening with Dashdot in terms of that, but that usually is what happens. Like in terms of, so the creditors will try and work out whether they can at least meet their superannuation or their entitlements around annual leave or whatever that might be. But these are businesses that, said they spent millions of dollars on investing in technology and software and modeling tools and all of these types of things. And that could be true, could also be true. So they've got no recourse to the buyer's agent. So then the next question is, who do they have recourse against? Because what's going to happen is they're going to go after the mortgage broker.
Yeah.
And the mortgage broker does have an asset, that's their trail book, right? So the reality is if you've worked with a Dashdot and you've worked with a particular mortgage broker, and you can see that there's been a referral fee or some money that's been paid between those two,
Actually,
in terms of, that they've got into bed together, I think those mortgage brokers should be highly panicked about now, because the reality is, and they won't be able to just quickly shut up shop. because they've got an asset behind them.
Yeah, they
So-
can't turn it off.
So the reality is if they do go into administration and try and shut themselves down, the creditor should be able to then go and recover that in the next couple of years. So, this is not legal advice, but the reality is if someone has given you advice around credit or whatever you've done, and there's been an incentive in terms of being able to do that through a cross referral payment or whatever, and or you're being coached into that, then that would be my next line of inquiry if it goes bad, right? Because no one wants to take accountability for their own story, but at least these vulnerable investors who don't understand what's happening, they probably have recourse in that respect. Whereas in businesses like ours, we do extensive modeling. We understand risk profiles. We go through that whole process. We do, multiple plans over the short term, medium and longer term. So from a responsible lending point of view, we've avoided getting people into trust lending and all of those types because we know what's going to come. And this is the reckoning for these types of buyers, and especially if we do see a regional wreckage, that this will happen. Like this, make no mistake, they will want to blame someone, and they'll go to Africa or they'll go wherever they can in terms of getting, remediation in terms of what's happened. So this is a reminder for anyone who is playing in this space. If you're working as a cohort and you're doing this type of work, you want to be very careful in terms of how it plays out. So
You would have been warning not just our listeners, but the broader market through your different roles and access to the media about this for at least the last 2 years solidly.
Oh, well, that's only because you've been around for 2 years, but I can tell you it's been almost 15 to 20 years.
Yeah.
I mean, as the chair of the property investment professionals, I was the one who was expelling the cowboys who were trying to leverage their brand against the associations, to get trust. I'm part of PICA or
Yeah.
PIPA or whatever it might be. And so, we would weed out those ones, and their first line of attack is throw lawyers at us in terms of natural justice and all that. Like they understand what they're doing, and they're very aggressive when anyone pushes back on them in terms of what that story looks like. So maybe I need to say allegedly in terms of everything that I say here, but that's the reality. So if you're going to be working with businesses that have these relationships and the broker is part of facilitating that service for you, well, what did they do around responsible lending? Now they might say, I just did the credit, and that's okay. Well, that's all right, but you got to ask the question but if you did the credit and you paid that company to get the lead, well, what have you done around your homework about the businesses that you're operating with? Again, in our case, we're branded under one name. We've got multiple services. People understand that there is an inherent conflict that's documented in our paperwork and everything that we do. And people understand that if they're going to be working with those parties, now it's still risk, like in terms of what that looks like, but that's the reality in terms of what we're playing here. Mate, I want to give you the final word. Can't believe it's already gone almost an hour. What's, if I'm coming to you and I'm sitting down, take me through the conversations that you would want to still be having about whether keep doing what we're doing. Has anything changed? What are some of the things that we want to be looking at when it comes to investing in residential property going forward?
Yeah, so my personal strategy over the last decade has been exactly what we discussed before: blue chip locations with land content. And typically, pre-budget versus post, I was a big land banker of old character homes and hold them, for the long term. And you might have to give some uptick along the way. What might change now post-budget is some of that gearing in terms of cash flow. So having more of an active strategy for us has become apparent, where we might, like I said, bring forward those renovations and or subdivisions if it's got development upside.
Yep.
The location in terms of the data that we track on a national level and a local level won't change. The fundamentals still remain the same.
Yep.
It just means we're a bit more active with our strategy. So if we do have an asset in a blue chip location, we'll likely be a bit more active with the renovation and whether we reconfigure the floor plan to increase the yield. So cash flow inevitably has become more important for our clients. So we will activate those strategies, and development, instead of holding that for the longer term and I guess pushing down the line in terms of when you're going to activate that subdivision, it may make sense for us to bring forward that subdivision, to bring on and create more land, which is supplies what the government intention was to do. But it'll be in location that is very blue chip, and the reason for that, what the budget might do, make it harder for these locations to have a lot of rental properties, because it makes it harder for
Correct.
investors to land bank
Yeah.
assets in own-occupier type areas.
Mm.
So being able to invest still in these areas, it means we're going to get an uptick on rental returns, because there'll be a scarcity of those properties. And, obviously they're going to become really attractive for long-term growth. So our strategy won't change in the sense of location and land still king. What has changed is cash flow is more important, so we have more of an active
Yep.
appetite for renovation and development.
Are you anticipating rents to go up through the course of these tax
Absolutely.
grabs?
Particularly within the locations that we're talking about, where there's been somewhat of a balance in terms of some investment coming in to provide rental properties. That will go. Those land banking opportunities may not be as common. And the problem is this, where I think people fail to understand. Some of these areas, it's the most vulnerable to get hurt. So if you're in a divorce situation, but your kid goes to the local school in an area, and you now have to find a rental property,
Mm-hmm.
it becomes really difficult, because rent may be 30-40% more than what it was 12, 18 months ago.
There's going to be a premium.
And you
There
can't,
has to be.
but you might, now you're on a single wage, and you can't afford to stay there. So do you have to move your kid from school? These are the things that I think the government really miss when they bring out these policies of who's going to get affected, and it's often the most vulnerable.
It's the unintended consequences of picking winners,
Yep.
And trying to change behaviour. But the reality is, if people want the best locations with the best amenity, or to your point, being close to family, and all networks and relationship breakdowns usually mean we need two properties out of one relationship in terms of what that story looks like. So I think that, mate, I think they're great final words. And if I can just add, in terms of one of the reasons why we get people like Lachlan on the pod is because he's actually a professional valuer, and he's also done his yards in terms of his apprenticeship around understanding feasibilities on land and investment, and technical valuation principles that come into play. And what is he still saying? He's still saying the same fundamental things that Bryce and I and the team have been saying for years, which is, at the end of the day, land scarcity attracts a premium, because it attracts people who want to live there, and they have the luxury of basically being able to pay that premium for those locations. So it continues to put underlying pressure on the square metre cost of that land, and that's what appreciates over time. Of course, there are the examples of the premium types of properties that sit on that, which bring that emotional attachment to it, and that the status of success that I want to show to everyone else. And you then just basically work through that hierarchy of land. So there's a hierarchy of land, and then there's a hierarchy of properties within that hierarchy of land. And that's what we've been trying to explain to people all along. And so again, well done on everything you represent. Congratulations on obviously the great business that you're also running. It's been a delight to have you on, mate, and we might get you on in a year or so time and see how things have changed. But I definitely, Bryce and I post budget, we're talking about this idea that there potentially will be some of those, locations that you land bank in with a future improvement to try and get the full benefit and the negative gearing in terms of 1 into 2. We're still trying to work out the detail about when. I mean, do you have to declare that one day that that's going to be? And then, so do you get the negative gearing up front, or when does the negative gearing kick in when you refinance it? So there's a little bit of technical information that needs to be clarified, because if we are turning 1 into 2, that's the way in which you're going to do it. And again, in established areas, people, where there's good amenity, there's good infrastructure, there's good commute, people will pay a premium for that, as well as obviously the agglomeration economy effect that happens in terms of the economic flywheel. So thanks, mate. Appreciate that. And until next week, everyone, I reckon we'll wrap it up. So bye for now. And remember, knowledge is empowering, but only if you act on it.
Hey folks, Opti here, your smart money sidekick inside more. Just one quick thing before we sign off. If you're new to the Property Couch community, welcome. One quick tip to help you get the most value from the show. Our first 20 episodes cover the foundations we build on every week. And yes, listening on 1.5 speed is totally acceptable. If you're short on time, download our free binge guide. It distills those episodes into one easy read with heaps of visual diagrams, alongside free tools inside More, your all-in-one financial home, to help you organize your money and plan your next best move. Check out all the links in our show description. And just a quick reminder before you go, anything we cover on this podcast is general in nature. It's not considered to be financial advice, and we certainly recommend that you seek out professional advice before making any financial decisions. Once again, everything mentioned is linked in the show description. Ready when you are. Catch you next week.